All right. I'm just gonna give people a little more time to get in here, but if y'all, where's everybody from?
Station San Diego.
San Diego. I'm in Butte, Montana.
Yay.
The west coast of Florida.
Or South Carolina.
I love how we're from everywhere. There we go. Go, Nicole. I know how I for whatever reason put on the waiting room. I don't know how I'm going to keep an eye on that as people try to come in and I'm talking.
Do you want to make me a host as well so I can,
There. Okay.
when they pop up, I can get people in, or it's up to you.
Yeah, let's see if I can do that. Let's see.
You just keep talking.
There we go. See, I can't make co-host. I can only make do the host also. Huh. Yeah. I don't have I must not have fancy enough account. That's all right. I'll have to just manage and pay attention. It's all good. Um, all right, just a couple more minutes here while I get this last thing up on my screen. Who's you guys can put it in the chat. Who's Gator? Who's sub two? Who's both? Do we got any OCs here? Or if you're came from the internet outside of
The interweb.
the communities. I know Blama's my VA here helping me out. He reaches out to people and gets them going and gets questions answered for me. Um, all right. And we got some more people coming in. Here we go. All right. Hello, everybody. I'm expecting more people to kind of populate. I'm going to have to pay attention to the room, the waiting room as well. Unless maybe I can figure out a way to turn the waiting room off while we're in here. Can you even do that? I don't know. Okay. That's all right. I'm glad to see everybody. I'm kind of the type of person that likes to start out my day, start out my meetings talking about what I'm grateful for. So I'll at least let you guys know. I know we have kind of a big group, so it'll take a while to go around the room, but I just want to say that I'm just definitely grateful for the challenges that I've had and the learning experiences. It's been a lot of learning experiences, I would say. And I'm just grateful to be able to help other people with the things that I've learned and lessons that I've learned. And hopefully keep some people from making some mistakes that I've made in the past. Um, with that, All right. It isn't a huge group today, so you can, come off mute and ask questions. Right now, we only have about 10 people on here, so this can be very interactive. But today we're gonna talk about underwriting, but I want to hook. I'm going to probably mostly concentrate on fix and flips just because it's hard to talk about all of it, and this is going to mostly be single family for today. But I want to talk about underwriting and then just how does that how does underwriting get affected? How does your profit get affected when you have different terms? So when you're using, when you, and this is, or how's it get affected when you're lending on something? So if you are lending in second position, which is very risky, how is that borrower's hard money terms being affected? So you can look at it either way. If you're a buyer, um, if you're a lender, if you're just starting out and don't know what you're doing, if you're bird dogging and wholesaling, you still need to know some of these basics so that you are more versed and able to, like even if you're a bird dog or a wholesaler, you need to be able to know what a good deal looks like, and how can you do that? So my calculator, I created this with my partner Tammy Jensen, and then we've kind of developed it a little bit more for some things that I'm using with Jordan Reyes as well. But I'll show you on my calculator. I'll share that with you today. And then I will talk about just one of my case studies that I'm doing. I'm in the middle of underwriting and closing a deal. Will not tell you where it's at, and I won't tell you some of the specifics yet, but you'll see it on our social media and stuff eventually. But um, but we're working on a project in, I won't give you the address, but in Kalispell area, Kalispell, Montana, Big Fork. And so I just thought this was really interesting because I spent a lot of time last week going over terms with different brokers, and one of my friends, Jason, is here. I have a handful of brokers that I've really got to know, hard money lenders, and really got to know. And they all offer just a little bit different terms, and some work, you never know which ones are going to work better. And it all depends. Like some lenders don't lend in certain areas, some don't like rural, which is what we're running into. There's just a lot of different things. And so you always want to we all know we want to have a wide variety of choices when we're trying to make a decision on a lender to use. Or like, I don't know, you might be helping a fix and flipper and you can give them resources. If you're a gator and you're white labeling, we may be able to help you with some white label resources also. I think I'll probably be working with a couple of my hard money lenders and seeing if I can help some people out as well and seeing what that looks like. So lots of opportunity. I mean, I think you guys know in Pace's community, I think most of y'all are, but if you're not, I'll probably put this on YouTube. So if you're not in Pace's community, that, that, that I'm just like, for whatever reason, my face wasn't on the screen. So if you're in Pace's community, there's a lot of opportunity out there, right? So that we work together and we can all find ways to make money together. We can all find ways to support each other. And so learning and understanding. I mean, the connector role is kind of huge. Like crazy enough, but I was able to connect
apps are
somebody.
concerned and kind of the highlights and things.
I was able to connect somebody the other day. It was kind of funny. One guy was selling an RV and another guy wanted to buy an RV, and I was able to connect them. And then they're both like, "Oh my God, this is so great. This is my first RV I've ever sold on a wrap. This is my first one I've ever sold on seller or bought on seller finance." So just I think that's kind of one of the biggest things is when you're networking, is just trying to, it's all right, Gina, it's all right. we're all human. I've done some really embarrassing ones, like yelling at my kids in the background. So you just really being able to connect people, and it doesn't really matter where it's at, right? It could be with hard money, it could be with an opportunity, and that's why I'm gonna put a link to a form in here. And what I like to do on any of my Zooms, I'll put the link out, I'll have everybody fill it out, and then what I try to do um, is I can send it out to everybody so everybody knows what everybody on this call was. And that's the good part about being live is you get the spreadsheet as well that gets populated when you fill out the form. But then also I know, like, if I have an opportunity, I know where I can go with it. And so that helps me, it helps you all, so that we all know what everybody's working on and where their expertise lies. So that's really important when you're networking. So, um, we've got kind of the gamut. We've got sub two Gator. Oh, Deb's been in sub two for a long, long time. And we've got some newbies and we got people that have been in for a while. So, and then, like I said, I've got Blama on, he's learning, he's, doing like VA work for me. And, Jason Harris is one of and I might have another broker jump on, but Jason Harris is one of my brokers. He actually lives 2 hours from me here. Met him completely outside of this network, but, so it's been a lot of fun meeting everybody. So super quick background. I started out in Gator. Well, I start my very first mentorship that I joined was the multifamily membership. It's actually where I met Jason. And soon after that I found Gator. So I joined both those both those mentorships, and multifamily membership was very expensive and it was only for a year, and I'll never regret things that I've done and when I get education, but that was a very expensive one. But we all know with Pace, he just provides so much value for, the one-time fee and everything. And so like that's just it's so cool to be able to stay in this community and work with everybody. So I started there with Gator, and I started doing private money connecting, and quickly I was lending my money and then quickly it was out. And so I helped connect on other projects, and it's connecting. I'll have a side conversation with you. Be very careful. It's a very tough job, and it's not for the faint of heart at all. So there's a lot of a lot of challenges. And so I was actually approached by Jordan Reyes and asked to join his team as his director of operations. So if you all know who Jordan is, just a super high level, he is the one who, if you've been on Pace's bird dogging trainings and stuff, he's the one who sold Pace, wholesaled, and partnered with Pace on his first RV parks. And I was actually there when he introduced himself to Pace and was like, I have 2 RV parks under contract. So that was kind of fun. But so now I'm working as the director of operations for Jordan and running all our back end stuff. And we're buying RV parks. He's buying RV parks, I guess I would say. But buying RV parks, co-living properties, and a lot of single families. We're doing a couple flips and just, investing in real estate in general. We also have a business that we're partnering with somebody on to help them scale. So, so yeah. So that's kind of where we're at right now. And it's just recently I was underwriting this deal. I was like, man, I want to share this with people because it was really interesting, kind of the variety, and especially with it kind of being a hard loan to fund, the variety of terms that I got. But so we know we'll start with the underwriting, right? So we know underwriting matters. We want to underwrite when somebody's underwriting a project and for a loan, they're underwriting the deal and they're also underwriting the person. I think a lot of the time people say you're not, we're asset based, and then they ask for your credit score, right? So you're almost always going to get a better terms if you have a better credit score and more experience. So and then liquidity. So those are the three things you want to have. You want to have for personally, you'll always want to be watching out for. You always want to be making sure that you have enough, you or your partners. And there's all kinds of combinations that they look at, depends on the lender, but you want to make sure you can hit certain marks, and we can talk about those some. But also underwriting the project. The project is the most important to make sure it works, but then you need to make sure that but then lenders want to make sure that borrowers will perform as well. And that's why they look at the borrower. So um when we're looking at underwriting, we want to look at the inputs. And for a fix and flip, like I said, I'll be concentrating on fix and flips, but I'll kind of try to apply it to buy and holds. But for a fix and flip, you always want to make sure that you've got the property under contract. You're able to get a good estimate on the rehab. And there's ways, like if you're a wholesaler, there's ways to do that that's really fast, that's just an estimate. And then as you become the buyer, then you want to actually get a contractor out and have the contractor give you the estimate. So it just kind of depends on where you're at, how in depth you have to be. But if you're, but you definitely need the estimate on the rehab, you need it under contract in order to get a hard money lender. Most of them aren't going to really talk to you. Maybe they'll have like an initial conversation, but until you get a property under contract, they're really not going to be serious. So they may do some preliminary gathering so that you can and find out some facts about you so you can have an understanding of what your terms are going to be, but you're really not going to know till you have it under contract. Then you want to be able to know what the insurance is going to cost. That'll matter. And gather the data about the property. What is their HOA? Is there how much is the taxes? All of those kinds of things. And those are the inputs about the property and the deal that will go into it. And then you want to learn about your financing. So am I financing am I getting private money? Am I getting hard money? Am I going to put some of my money in? Maybe there's a different capital stack, and I'll kind of brush upon some other options out there that some people don't think about, but I think most of us have heard of just because of the community. But there's a lot of different ways that you can get the money for the project, and thinking about what does it mean if I borrow private money versus using my own? Where's the risk? What is the risk? What changes the risk? And if I'm going to use my own money, what does that mean? What's that look like for scaling? So trying to figure out exactly what capital stack you want to use in order to get the project done, have the risk at the level you're comfortable with, and be able to do the level of amount of work you want to do at a time. So if you want to be able to do 3 or 4 at a time and you're at that level, that's a different consideration than if you're just doing one and your money's going. And so you may be more likely to put your money into one, whereas if you're doing multiple, you will want to keep more liquid. So some of those kinds of things. So you look at the capital stack and you can underwrite it several different ways, and we'll kind of play with that a little bit on the live estimate. And then exit strategy. You always want to have, there's not a lot of different exit strategies. There's variations of different exit strategies, but there's not a lot of different ones. But so you got sale and then you got hold, right? But then if you're going to sell it, there's kind of a combination between sell and hold. If you're going to wrap it, you can, so those are kinds of things to think about when you're looking at the exit. But basically sale and hold, you always want to estimate based off those, and you always want to be conservative. So use like your most conservative estimates to start, and set what your requirements are. And this matters for a lender, for a borrower, for anybody, because even if you're a wholesaler, when you want to understand if you're a wholesaler, what a buyer is looking for as far as their bottom line. If one buyer wants to have always get 10% of the ARV, but there might be another buyer out there that, it was like, I'm just not wasting my time unless I'm going to get 15 to 20% of the ARV. So, and I'll show you on our criteria, it actually depends on if we decide if we're going to bring a private money partner in or a private money lender in, whether we want to have what the return is, and because it changes the risk. So those things are important. And then can you refinance it out if things really hit the fan? And that's really important if you're lending private money, especially in second position. Can that borrower refinance out? And a lot of fix and flippers do not have the credentials to refinance out. You have to have liquidity, you have to have all the things. You have to have a better credit score. Usually the property has to have a debt service ratio that's high, and 1.25. If you guys, doesn't anybody know or have questions or not understand what a debt coverage service ratio is? So I'll just hit it high. It sounds like everybody knows, but just so then high level is you want to make sure your PITI want to make sure that your PITI is high enough to cover or is low enough that your rents can cover it. And then usually it's like 1.25 times. So making sure that you are financeable on the back end so you can get out of the loan if you need to, and or have a way to bring in a partner or whatever that might look like. So I'll get to the nitty gritty now, the fun stuff. Pull up my spreadsheet here. Share my screen. All right, so and I see there's an error down here. We'll figure out what it is and we'll fix it. But this is our spreadsheet from the project that we're working on right now. And like I said, it's in Big Fork, Montana by Kalispell. But the purchase price for this project is $745. It actually was listed for like 9 something, and Jordan got it under contract for less. So the rehab, it's a full luxury flip. So the rehab is 370,000. So the total, you'll hear a total loan cost, you'll hear that term is 1,115,000. I have a spot here. You can enter the EMD that's put down. We actually put 7,000 down. And you can modify, like there's some things here where, but we're gonna have to pay back the CMD. So it's really, came from a lender. So we're really should need to add in what we're gonna pay the lender out. So there's just different things you can add in here to really calculate it really tight. But the project length, if you're a PML, I would never expect a project to close faster than 6 months, by the way. So if someone's telling you that it's 3 months, okay, 3 months, and then how long will it be on the market? Those kinds of questions. So just something to really look at. And then on my calculator here, it defaulted. So this is my estimate. When we first started, we knew that we'll probably get somewhere around a 10% interest. So we defaulted it to 10%. We said this is a luxury flip, so it's going to be at least 9 months. And we calculated it as, it's actually calculated as Dutch interest, right? So Dutch interest means that they're going to charge you on both the how much they lend on the principal, and even if they're holding it back, they're going to charge you for that rehab, even if they're holding it back. So that's what Dutch means. So non-Dutch means that they're only going to charge you on what, and I'll show you an example on what you actually borrow. And then you also have some people, some lenders that will actually front you the rehab costs, which I've learned recently, which is pretty awesome. So there's just different ways to look at it and different ways to that this interest rate is calculated. And you'll see how when it's non-Dutch, it's going to be like $10,000 less that we're paying because we're not paying on the rehab until it's drawn. I always just put some utilities in, HOA if it's there, and then the taxes and the insurance. I actually, this calculator only calculates how much it's going to cost for the 9 months of taxes and insurance, but a lot of places you have to bring maybe like the whole year in. So I actually like to put the whole year in, just knowing that I'm going to need that up front. And then it's just a nice surprise when I get a few $1,000s back that I wasn't expecting. So that's the total, carrying costs, and some of these come up front, is $81,000 for this project, which is a lot of money. So making sure that this is where we're like, oh, we really want to make sure our risk is mitigated here, because it's a good project, but it's also there's risk. I always start my underwriting out at 2 points for the broker and 2 points for the origination fee, but you'll see it all depends. I have one that's 4.5 total, and I have one that's 2. So it all depends on that. Appraisal fee, I always put in just about $800. And then this just depends on the hard money lender. And like I said, we'll look at some different terms, but some of them have underwriting and processing fees. And so you kind of got to watch that, because you might come up a couple $1,000s short if you don't pay attention to all the fees that they're going to put on. I
And
always
is that the TC fee, underwriting
no.
fee,
Okay,
processing?
I'll show I've kind of put some of those down here.
Oh, okay, I see it. Never mind. Sorry.
Yep. So the total financing fee then, if we're counting all these, is $40,000. So just to get the money, we're paying $40,000. So right there, you're at 40,000 plus 80, you're at $120,000 that is not part of your profit. So something people don't really realize. So the closing costs, then you have closing costs, which I put in 1% of the purchase price. That's depends, but it's kind of high, but it at least gives us an estimate. And again, then I can be pleasantly surprised if I'm a little long, or I have like a little bit extra if something comes up. I need to check and see if anyone's tried to join here. Nope. Okay. So then this is kind of more, this just depends on your operation. It depends on, are you wholesaling? Are you buying? Are you lending? What's going on in your operation when you're underwriting? But in general, if you're going to use a TC for something, it's going to cost you about $1,500. If you're going to hire someone to help you underwrite it, it's going to cost $500 to $1,500. And then the acquisition fee, I've just put it in here. Most anybody who's specifically doing a buy and hold is going to put an acquisition fee in for themselves, and how they get that acquisition fee will depend. Most hard money lenders won't lend you that acquisition fee, even if you're like wholesaling it yourself, or they won't even lend you a wholesale fee. So you have that will usually come from a private money lender. So if you're hoping to buy something with an acquisition fee, that's usually coming from an investor that you bring into the deal. So what this all is we're talking about $1,256,297 to do a project where the purchase price was 745,000. So that's kind of big. So then we go over here to this column, and this is we're talking about the principal. And so I underwrite, I start at 80% of the principal and 100% of the rehab. Almost every lender is going to give you 100% of the rehab, but there's some weird things where they'll be like, well, the max loan to cost is, so when that's where this number comes in, the max loan to cost, so this would be the loan to cost here, is a certain percentage. So they're like, we'll only give you maximum. For instance, this loan to cost 966 divided by the total cost here is 86, right? So there's different reasons they might give you less rehab if your loan to cost is not where it needs to be. So it's the terminology matters. If they're talking loan to cost, loan to value, there's a lot of different ways to look at it. So you have to be really careful and ask a lot of questions sometimes, because a lot of time brokers aren't going to give you like an actual term sheet to start. They're just like, hey, this is kind of what we're offering right now for someone in your credit range, but we have to underwrite it to know and all the things. So they're going to mostly just give you like, this is what I think I can get you. So a lot of the time you might not see these fees and different things. You might not know. So you kind of ask ahead of time. Because underwriting it will be very different if they add fees on that you didn't know about. One of the loans, they lend it to you, but they hold it back. They lend you 6 months reserves. So I would change this to reserves, and I would actually put it in here as $76,000 for 6 months of reserves is what that was on that term sheet. So lots of different ways to look at that. But then that means you're not actually paying this amount every month. It's automatically paying from here. And then what this basically is doing is it's balancing, here's the money that we need, and here's the money that we're going to get. And so if we didn't have a PML, we would have to bring $290,000 to this project, not necessarily the closing. Sometimes you need to bring there'll be a difference. You have to bring a certain amount to closing, but then you have to show a certain amount of liquidity. So like one loan, they want us to show a total of $301,000 liquidity, but we only have to bring 250 to the closing table. They want to see that other 50 to know that we can make payments throughout the month. Or throughout the months that we're holding the project. So they're very different, the way that the terms will be outlined, and you have to really pay attention to it and really make sure you understand, like, what does that actually mean? And then sometimes a lender will say loan to cost and they really mean loan to value, and you have to like get that clarification, because it makes a difference on your underwriting. So how are you gonna how are you gonna bring $300,000 to the closing table, right? Are you going to get a private money partner? Is one of your partners, somebody you know, have 300,000? They're willing to come in and get a return off the project, either partner with you or just do PML. Do you have $300,000 of your own that you're going to put into it? Or there's some other options that are very interesting. So there's options like getting a personal loan, and you can get a personal loan, and then that hits your personal credit. Hard money doesn't hit your personal credit normally. You will get a credit inquiry, but it won't show as debt that you have out. But you can get, a lot of the time you can get an unsecured personal loan, and that loan will show as debt against your credit. But if you are watching your risk and being really careful, what happens when you pay that loan back? That just jacks your credit up even more. So you have to think about that, like, where's the risk? Where do I want to take the risk? Do I want to use somebody else's money and take that risk? Do I want to use my own money and put all the risk on me? or do I want to borrow money and have the risk of having to pay that back? And looking at all those different situations will help you determine what the best course of action is for you. And then there's always credit stacking. Most gators, you all know what credit stacking is, but there's companies that can help you get credit cards, and those credit cards can um, help you do the renovation. So any of your contractors or anybody that will take, especially if you're doing like you're GCing it yourself, you can actually use credit cards a lot to do the rehab, and then and then you only need a little bit of your own money to actually complete the rehab. Um and sometimes lenders will take all that into consideration if you're like, if you can show them how you're going to get the rehab done if you don't have the liquidity. Also, liquidity, what you have to look at for liquidity is the sources. So if you're liquid but you're showing your 401k, that's different than being liquid and showing cash in the bank. You can still use your 401k, even if it's tied up with your employer, if you're employed still. But they'll only usually count it as like 50%. And same thing with a HELOC. They'll only usually count it as 50%. But then I guess if you just go take that money out of your HELOC, put it in your account and show that, then it's in your account. So it's an interesting game. I don't want to say game, I mean it, but it's an interesting terminology. And then when you're looking at liquidity also, they will look at where the money came from. So you can't just go get money from somewhere and then not show where it came from, because they'll want bank statements from, 2-3 months back. So they want to know where the money came from as well. And so if you're borrowing money but not disclosing that, that might be a problem for a lender. Some lenders won't care and some will. Some want to know if you're gonna have a first position, and others don't want you to have a first position. Some just want you to not close the second position on the same day as the first position. Everybody's different. Others, they'll never, ever, ever check after. And other lenders, basically if you are starting on your own and you're just gonna do your own money, but then you get in a bind and you're like, oh, I'm gonna have to bring a partner in, or oh, I'm gonna have to put a second on somehow. Most lenders, actually, most HMLs probably will not check that or do anything about that. It's not like they're going to call the loan due. So that just goes into your risk factors of like your backup plans in case something happens and you're using your own funds. How do you get a project done? Can you go out and get that other part of that credit stack that you were not planning on getting? And then so many things about hard money. So when you're really, and that's kind of what I want to dig into, is this capital stack and how this is structured is really it really makes a difference. And you're going to see here where my net profit on these projects swings all the way from, like, I think my estimate is the lowest at 224, but then I have one where we could make 300,000. So it really makes a difference in that. It's really obvious on this project. So this project has an ARV of 1.6 on the low end, and on the high end 1.9. We underwrote this with a PMP. We're going to partner with a local contractor that's going to partner with us. He's a local real estate investor, not in our community, which is kind of awesome, but he's going to partner with us. And so he's going to get, we're actually doing 50-50, and you'll see on my other ones that we're doing a 50% split. So actually, when I'm comparing my numbers, it's this one that I'm really looking at, because we're just 50-50 with the partner. So yeah, this one's 280. I guess I think I have some that we're making like 270. we'll see them. And then what we're really looking at is our minimum. If somebody's going to be a PMP, we really want this to be 15 to 20% return. And so this is 14, and that's at our bottom, so we're okay. And of course we did this at 20%. These are kind of our like baseline. We know that we're going to make a little bit less percent return because we're bringing in a 50% partner, but we have decided that that's the way we want to go because we want to work with that partner and build that relationship. And it just helps us in a lot of ways. It will help us have to have less private money up front since he's the contractor and things like that. So all of that comes into play when you're looking at a project. We also have, and it's not actually used in this calculator really, but you can also calculate it as a PML. And so a lot of PMLs, especially second positions, are at least 12, are right around the 10 to 12% interest rate. And so it's funny, Jordan's in here. So they're around the 10 to 12 interest rate here. And so they're basically you can calculate and put in here that their return would be, 9 months times 2,900. And so it will change these numbers. And so instead of doing equity, you can do PML. But then you got to take into account, a lot of time what I'll do is I'll add another payment area in here and add the PML payment in too, so that this number actually goes up because now I have more holding costs. So with a PMP, you aren't usually making payments. You're usually just doing a equity split at the end. With a PML, you're usually making payments. So those are the two differences when you're doing talking about these types of deals. And then there's other structures, but those are kind of the two main ones. When you start getting into some of those other structures, you got to start talking to a lawyer about SEC rules and different things. And so I won't really go into those and decide if you're going to take the risk on lending on something that could be a usurious loan and all of those kinds of things. So, and then you always want to underwrite for, like I said, a refinance. So I'm like, I don't know what I did here. G8, G38. Oh. What is it doing to me? Okay. So this is an estimate when you're talking about hold and you're talking about DSCR loan, there's a lot of different flavors, but there's a lot of factors that go into it. I discussed the PITI versus the rents. Some DSCR lenders you have to season, so you have to have the property for 6 months or 3 months. Some lenders you is 75% of the ARV, and that's if you're going to do a cash out. If you want cash out, then it's 75% of the ARV. If you have high enough debt that you want to do an 80%, then you can't get any cash out. So it would just be the max debt as long as it's less than 80%. So a lot of the time I underwrite an 80% as kind of the worst case scenario. Most lenders you'll be able to get 80%, but there'll be different things like as long as you have the right credit, right? But there'll be different things like what is the how long is the holding period? So DSCRs, a lot of them you have what is that? A prepayment penalty. Almost all the ones that I've seen, and Jason being on here, he actually has some crazy different terms, so he might have some that aren't like that, but a lot of them have that have a prepayment penalty. And so that, like, one of the ones we had to do was 5-year 5%, and then year 4, if we refinance it year 4, then it's 4%, year 3, so actually year 1 is 5%, right? And so if the length of time you're in, it's less percent prepayment penalty. So when you're doing a DSCR, you really want to look at, when are you going to want to exit if you do a DSCR, and what does that mean for the exit? And so different ones, depending on your ratio, if you're 1.1 versus 1.25, then your hold times change, and you can buy it down with points, and it's a scale. But it's very important to understand, and I've had to say this to people because they don't, even brokers, they're like, no, it's 75%. I'm like, but can you do a rate and term? So remember that rate and term, because there's a difference between the normal DSCR and a rate and term, and a cash out refinance is usually only 75%, but a rate and term a lot of time is at 80%. And so this gives me
Hey, Jen.
yeah.
Yeah, I didn't mean to cut you off, but before you keep going on, does the DSCR fit a single family home?
Yeah.
Would it fit this particular deal here?
I'll tell you here. That's what I was just gonna show you really quick.
Oh, okay, sorry.
So I went ahead and said, well, a lot of the time, if my ARV is 1.6 at the minimum and 1.9 at the max, a lot of the time I'm probably going to get an appraisal that's a tad over, be able to get one that's a tad over my minimum. So I just went 1.7, but you can play with this number. But at 1.7, and then the total loans is 1,256,000. So 80% of 1.7 is 1,360,000, with an estimate of 1.5 points for closing costs, and what do I have? 2.5 points for the origination fee, which a lot of time DSCRs are less. Again, I like to just be conservative. Then I would be able to cash out 49,600. That pays off first position, the holdback, and the principal of the PMP. But they're 20%, but if I was going to pay them a 20% return, which again, that's a structure that you have to really decide if you want to do, because you're talking about, depending on the state, you could be talking about usury. But if that is a structure that you're doing as a lender, then, and or just taking on as a borrower, and you're talking about risk there, then if I owe them another $56,000 on top of their 290, then we're talking about then we're talking that I'm probably going to need to bring 6,400 to the closing table. Or I talk to that private money partner and say, you want to keep some equity in, let's use this 50,000, let's go furnish it and turn it into short term. And if the private money partner is good for that, then you can do that. So there's just different ways on the exit to work with people. And then these numbers, I'm kind of working on this a little bit, but like these numbers show that a 20% 20% equity is a 19% return on this one, and 20% equity is a 39% return on that one. So I haven't labeled those, but I just put those to the side. So I got a quote from a broker that said, well, you can get the rehab funds up front. Well, the way I underwrote it, I still need a part, like my own money in or a partner in or whatever that is. So the way that I underwrote it was the same, except for that I have another comparison sheet that kind of says what is going to happen at the closing table. And that's where the difference is. I still need a certain amount of private money funds because, or my own funds, partners funds, because those funds are going to be needed to to close a project and finish the rehab. So we can talk about really what that means. But overall, this loan, there's no broker fee, and the origination fee was 2 points. And this was, they were going to fund 100%. It was going to be I think an 80% of the purchase price and 100% of rehab, but they were going to fund us 100% of the rehab up front. So you can see with these set of terms that now the gross profit is 300,000, whereas my estimate was 280. So that's 20,000 more than what my estimate was. Now it's a less percent of ARV because we're splitting 50%, but you apples to apples looking at that, it's nice to see that that nice profit there. I have this other one, and so this one is inherently Dutch because we're getting all the rehab up front, right? So we're getting all the money, so it needs to be underwritten as interest on all the money, right? But on this one, they're going to hold back the 370, and we have to get draws, and they're going to do a 90%. So not, and this one actually is probably a loan to cost type of thing. But so they told me that my principal would be 654. So it's somewhere around, it might be 90% loan to cost. Because that is, yeah, because that's 87.78. So it's probably 90% loan to cost. So that's just that, those are those differences that I talked about. So this one had non-Dutch interest. So the way I calculated, I made this little table and I said, just as an estimate, I think our rehab's going to take 6 months. And so if I just equally split out, which this isn't realistic, obviously you're going to ramp up and some months are going to be more than others, but just to give an estimate, I said, I'll do a sixth every month. I'll pull a sixth of the budget every month. And then I calculated my interest on that. And then obviously it's all out the last, say, 3 months while we're put it on the market, furnish it, put on the market, sell it, all of those things. So then I was able to come up with 75,913. And I actually just changed the calculator and I backwards calculated. I put this equals that, and then I divided. So my average monthly payment over 9 months is 84.37 compared to 8,000. That's actually surprising to me. Let's compare it to this. Because the interest rate, so the interest rate is 10.99% and compared to 10%, and this one was actually 9%. So even though it's non-Dutch, I still pay more. Weird, right? That's where that's why you have to do this. Now, if this same loan with the 10.99 was Dutch, then I would be paying I'd be paying 10,000 more. And that's where I got that 10,000 more I'd be paying 84,000. Right? So that's the difference there on the Dutch and non-Dutch. What else with this one? Yeah, it was just a straight 90%. I think it was 90%. Yeah, 87, 80, it was like an 87. They gave me that 654 straight up. So that was how their calculation worked. And a lot of the time they'll go off of, well, and then you can't be, and then your total loan to cost can't be any more than this percentage of the ARV. And so there's like a bunch of different calculations that go into that. This lender, I'm still vetting. If anyone's heard of Source Lending, let me know. Otherwise, I'm still vetting them. They're claiming they'll fund the rehab up front, and they are claiming that, what was the other thing that was really good about this one? They're claiming a non-Dutch, well, I guess it's Dutch because it's everything up front. So I actually have to fix this calculation because they are claiming they'll fund it all up front. I'm still trying to understand their terms. But they did claim only a 9%, I think 9.25% and 3.5 points. Oh, that was what I did talk about that, right? This one's 2.5 points and no broker fee. This one is 2 points and no broker fee. So those, comparing those matter, right? And then I think one of the loans, they were like even going to give us 18 to 24 months. I think it was this Barack one. Everybody else was 12 months. So what's that do to our risk? Is that better? Is that worse? What's that look like? So all of those you got to look at. And then this loan, this is kind of more of just your typical. This was a non-Dutch though, and it was a 11%, so it's on the higher side, but non-Dutch. So at non-Dutch and 11%, my monthly payments are still equal to about the same 75. We're at 76 here, we're at 75 here, we're at 65 here. So almost all of them are at like 75 except for this loan at this point. So calculating that out and see, we're paying technically Dutch on this because we're getting the funds up front, but because it's only 9%, it's less. So just calculating all that out and seeing what it does is just, to me, I just thought it was crazy. So that's the main thing with this. And then but then these points were 3 points. I think they actually told me 4, but they're like, what happens if we drop a point? Because they want to be competitive. And it still isn't competitive quite enough. On this one, we're looking at 280, Source Lending 266. And so why would we want to, if we were going to make 266 versus 300, why would we want to do that loan? Anybody have any idea why we would even consider it?
Build a relationship with that person, that company.
I think we would consider it because of risk. If they're going to fund the rehab up front, that's less risk for us. That means that we're more likely to be able to go quick on the project. And so in that case, if I'm able to go quick and I'm able to do this in 7 months, now I've just gained 16,000 more. And now I'm back up at the 280 time area, right? So what does that do for me having that rehab up front? And why else would I want to do it? I only have to bring a PMP in for 140. So maybe now I only need to give them 25%. So because they're only coming in at 140 versus 300, just because of the way these terms turned out. Right?
Hey,
So-
Jen.
Yeah.
On the number that high, do you also, because they're coming in with the rehab money, do you also give them equity at that point just to push it faster?
For the PM, for the lender?
Yeah,
Well, most of these are hard money lenders, but you'll find private money lenders out there that will do all kinds of things. So it just
yeah.
depends, right? Mostly I'm talking about hard money lenders, but there's a lot of private money lenders out there that are pretty much structured just like hard money lenders, or they'll say, well, heck yeah, this is a good project. I'm going to give you a lower rate, but I want a little cut of that pie at the end, or maybe they'll lend you the interest reserves. I think I have one in here where the interest reserves are lent. So that's it just depends. So you might find terms, even though a private money lender might seem more expensive, they might not be. Um, so that's why. I mean, this is the worst loan as far as profit, but we might make more or similar because like if this is 50% and we're 141 because they got to bring 230, same thing here, 150, we make 150 because they got to bring 270, or oh, that's not a good example. So even though the total profit is higher here, we actually might be better off if we only need 140 and we only give away 25% equity. And now we made more money. Crazy? Crazy.
Hey, Jen.
Yeah.
Um, you don't need 270 with me.
Yeah, we can talk about that because I don't always necessarily understand. And again, guys, I don't understand. So we'll have Jason come back in here actually and correct us in a minute. Let me get through these other examples just so everybody can see all of this. So then we have and I'm sorry I'm going long. If people got to drop off, you guys feel free to. And so then this is another example where we're at, they said they would fund 663. It was something about 80%. And they were at like a little fee for the broker of 695, and then they were at 2.5 points. So just different things. And they told me about some of their other fees, processing fees and stuff. So I was able to put those in there. And then like this one, honestly, I would only need like 240, right? And so what does that look like if I only need 240? But this is it hits my bottom line pretty hard because that's a 12.1% interest rate. So that's $93,000 in interest I'm going to pay. And it is Dutch. So my understanding on this one. So that's a big deal. So definitely I would say this is a no. Is definitely my lowest. This one's pretty not the best either, but this is our normal lender, and just with this being a rural area and 10.5 acres and everything, everybody's having a hard time getting us quotes. So they were at, you can see here where I had to do some funky math, right? Because this was I could tell by the wording, it was kind of a true LTV. So this was going to be a loan to value of, I think 80%, but it's not 80% of purchase price. It was 80% of loan to value. And they were going to lend you the interest reserves, but they're going to hold those back. So that comes out of your principal. So we're still getting $1 million, but 76,000 of this payment is getting held back, which is like 6 months of it. So it calculates different, right? So now we need 275 to get the funds here and to get what we need. And then our profit's 254. And if we're splitting it in half, then we make 127. So what I did is I stuck these. Oh, that's the comps. There it is. I was like, oh no, my spreadsheet's gone. So what I did was I put it all side by side. So I took some of the key information out of each one and put it side by side and kind of ranked them by the estimated profit. Now I didn't do it based on what we're gonna pay a partner, which is different, but you can see the different amounts of PMP that's needed based on and the percent of ARV that we're going to make and the loan total that we're going to, and just how the different amounts, the points and the loan to value, we got loan to cost versus loan to value. And this one actually had a loan to ARV max also. So and then there's the interest rates. I got anywhere from 9 to 12.5. And then there's, the terms. And I think this one is actually really much more like 18 months, which was kind of cool. And then if it's Dutch or not Dutch, and then I have the notes. And then some of them I said, okay, we can partner and we can get up to 740. So I had them run it at to get certain terms, we said 740. And then other ones, they're like, it doesn't, anything over 680 will get you these terms. So I may get pleasantly surprised when we come back, depending on what we use for a partner, who, what his credit score is or how that works out. And so we may be pleasantly surprised there and get better terms based on that. Like this lender, even though they're not the top of my list, but they weren't terrible, they can close in 48 hours. So they're my backup, right? If somebody falls through, I can run to them and scream help. But you do have to pay a little fee up front for the underwriting, but there's no appraisal. And then this lender, they had the note that the interest reserves and costs are built in to the loan. So, there's just a lot of different things that go into it. Questions? And then Jason can correct us on these terms. But does anybody have any questions or comments or like something else they want to?
So they're using your personal credit score to determine the rate?
Yes.
Is that what that is?
Yeah. Yep. They use your personal credit score. You will get normally. There are some lenders that will do a soft pull, but they will normally pull your credit and you'll get, so you don't want to go to all these lenders and give them your social security number because then you'll get all these pings. But of course, if you get a bunch of pings all at one time, they're usually counted only as the one. It just depends.
Yeah.
And then, and you can get some removed, but I've never went through that exercise.
Can you just provide them with your credit report?
Mm-mm. They want to pull it. Most of them want to pull it themselves. They'll
You can for a quote though up front.
Yes, I was going to say that. Thank you, Jason. So they will a lot of the time for the quote up front and like to a certain point, they will just use what you tell them or what, like if you give them a screenshot or something, but then they will want to pull it before the end. Usually.
Yeah, you're right. Because if you're shopping and like, 3, 4, 5, 7 lenders pull your report, your score is going to go way down. So then what's the point of having a better rate? Because now your rate just went out the door.
Yeah, that's why they'll kind of pre-qualify you based on what you say it is and maybe even like a screenshot of your credit report. But be careful. Like I love Experian because they alert me and stuff, but the credit score is not correct. It says I have like an 830 and it's like, yeah, I don't have an 830. I have like a 740 or something. But so you got to make sure that you're looking at the right type of credit report.
So do you go with the other TransUnion or something?
It's not TransUnion versus it's a type of credit score. So it's I don't know, something 8 score that and it's really high and maybe it like works for like cars or cell phones or something, but it doesn't work for mortgages. And so it's the type of credit score, but like a lot of you can compare it to like your credit cards and stuff. And so a lot of your credit cards will be, there might be different ones that are more accurate. So you can check all the different places where you can get your credit pulled. I have like 3 or 4, like I have different credit cards and stuff that are all I'm able to use.
Yeah, I mean, my bank gives, those scores too. Please check your score, blah, blah, blah.
Mhm.
I thought that they were accurate, but now it sounds like maybe not.
If your bank's pulling it, probably.
Okay.
Yeah, they have different like
Well,
credit
they're not pulling it. They're
models.
just showing me like, TransUnion or Experian or whatever.
Yeah. When I say Experian, I'm talking about the service, the credit check service, not the actual credit report Experian.
Oh, okay.
Yeah. What's that, Suman?
They have a different like FICO model that they use. So like there's like a 8.0 and then I think they went up to 9.0 or 10.0 or something. So like what we see in like Experian or TransUnion, like on those credit reports are different from what they're looking at. So the numbers are not always accurate.
Yeah.
Well, how are you supposed to know what your accurate score is?
Um you are close. What you're looking at as a consumer, it is close, but it's not like what they're looking at. So you have to, I know, it's ridiculous. And there's like a
So much for
different,
transparency.
yeah, exactly. There's like LexisNexis that they pull from, and there are a bunch of different places that we don't have, like common folks don't have access to either. So, but yeah. But I do have a question about Dutch.
Yeah.
I'm new, so like this is literally the first time I'm hearing about this, and I'm so like feeling overwhelmed right now. I mean, it's good and in a good way because I need to know this to be able to scale and pivot and stuff like that. So like the difference between Dutch and non-Dutch is they charge interest on what again? Sorry.
The holdback. Dutch,
Okay, got it.
yeah, they charge interest on the holdback when it's Dutch. So even though you don't have the money in your pocket, you're paying for it.
Ah, okay.
But it's not always bad. I just showed you guys an example where um non-Dutch went right along. It was or Dutch, it was the same as some of
Yeah.
the Dutch one. Yeah.
Okay.
You have to,
Is it rare to find a loan to ARV lenders? Because I mean, to
they
me,
have
like,
both. Usually it's both,
yeah,
right? Usually it's they'll give you a LTC or a loan to value. Loan to
okay,
value is usually like loan to purchase price.
right,
So they're just saying they're only going to give you 80% of the purchase price, or they'll do a loan to cost. But then sometimes when they say loan to cost, they really just mean loan to value. So you have to really get like ask like what that means. But a lot of the time they have both. And so if it hits 70% of ARV, the total loan, but it's like, so just like if you say you're at 75% of loan to cost, but you hit 75% of ARV, no idea how you're going to do that, but it can happen. Then that's where that would be a limit for you.
okay,
But I know there's lenders out there that will do 100%, and I couldn't get one for this loan, but they basically calculate it like this. And anybody who, if you're doing an initial underwriting, like when you're first just checking if you should even consider putting in an offer, you want to use the golden rule. So if y'all haven't heard of the golden rule, it's 70% of ARV minus rehab. That's what your purchase price should be. Right? So that's a starting point. So it without having to do like a ton of research on the property and everything, you can go, okay, what would my offer be? And so on this one, if I look at the house and I go, okay, it's 70% of these decimal points. So it's 70% of the 1,616,000. It's a percentage. So 70% of 1,600,000 is 1.2, and our rehab is 300,000, 370,000.
Yeah.
So my purchase price needs to be like 750, and we purchase it for 745.
Okay.
And so how do you get a rehab really fast? If you're a gator, I actually really love Abraham's PML underwriting course. And I actually literally go back and thumb through my notes, because I told one guy that wants to come orbit with us and work with us that's going to do underwriting. I told him that he should watch that course and then give me a cheat sheet on that because I just go back through my notes. But Abraham has some pretty good rehab estimates. One way a lot of people do it is they just say, okay, if it's full gut, it's $100 per square foot. If it's medium, it's 50. If it's lipstick, it's 30. And so for us, like, this house is like 2,100 square feet. So at $100 is per square foot is what? I can't do math. 2,100 times 100 is 210,000, but we're doing luxury. So now then you add a percentage on top of that. Plus we're going to redo a lot of time you don't have to redo the siding, or you don't have to do the roof, even though you're doing a full gut or whatever. So we have to add all of that on because we're redoing it all, because even though it's pretty new, it's not right. So that's a way to do it quick, especially if you're just wholesaling and you just look at it and you're like, that's a gut, that's medium, that's lipstick. And then, but Abraham shows that, and then he also shows he'll also go, but if you need mechanical, add on 5,000 for HVAC and da 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 da. So that's how you can do it really fast if you're just looking at something and trying to figure out what your offer is. And if you're wholesaling, you want to do that and then subtract your wholesale fee off of the offer price.
Is Abraham's PML course, is that in the vault, or is that like something that like
It
people
was
have to
a semester last year. Abraham and Alexis did it.
So like I have another question. Rate and term. You talked about rate and term. So that is that just another type of loan, I'm guessing?
Jason, do you want to answer this? What a difference between like a rate and term and a cash out is for a DSCR?
Sure. So a rate in term is you're not getting any cash out per se at the end of the transaction or closing. So the way you could get your private money person paid off is have them put a lien in for what they put in. Then it's considered a rate in term, so that all liens have to be paid off in order to have clear title. So while the borrower that is doing the refi is not getting cash at closing, the liens have to be paid off. So that's how you get a rate in term versus like a cash out. It's like you're actually receiving cash at closing, and it's not being sent to a third party or lien holder beneficiary. That's considered cash out. And so then you have a reduction in loan to value that you're able to go ahead and tap into, which would be 75% typically. Whereas on a rate and term, you go 80, 85%, typically 80 safe to be at. Now there's ways to break that up too, because you can actually go above that, but you'd have to restructure it with a first and a second. There's banks out there that'll go up to 90% CLTV on investment property, but that's a full doc loan. That's like last ditch. I mean, it's like you're buried, and it's the only way to get out of debt is that. That's the best. Yeah.
Okay.
Did I answer your question?
Kind of. So rate and term is
With a
It's
rate
just a
and term, you can't
restructure
get
of
any
the
cash
loan.
out. You can't get any money back into your pocket.
The
That's why you
borrower
can
cannot
go.
get any money back out into their pocket, correct?
okay, gotcha.
So they let you borrow more because you're not putting money in your pocket. It's all into the property. But
Well,
if
correct. And all those liens are already attached to that property. So those have to be paid anyways. So that's where they're allowed to, since you're not doing a cash out, you're able to go to a higher loan to value on that.
Okay. That makes more sense. Thank you.
No problem. And Jen,
Yeah.
just to let you know too, I'm waiting for another quote. I actually have a 90% LTC coming over. I'm expecting, and that one's full boat as well.
for
Dutch
this
rehab cost
project.
for this project.
Cool.
So I'll
Okay,
shoot that over.
what do I have wrong on this term sheet? What do I have wrong on the way I put this in?
Where are you getting your 270 from? Because I'm only requiring 20%.
Because this is the
Oh, you're adding
total
your
we
holding cost?
need. What's that?
Okay, you're holding your target, you're including your holding costs.
Yeah. To do the
Okay.
whole project as the investor, we need 1.235.
Okay.
And the loan will only give us 966.
Mm-hmm.
So we need 270.
Well, I could probably get you an extra 2%, because your 966 isn't at 70 yet.
Okay.
That'll help out with what? About 13,000 or so.
Sound good to me?
I'll work it up. I'm getting those hard term sheets over the letters over for the terms, and I'll get those over to you.
Okay. Yeah, that's how I get 270. We want to make sure that we have all the money. And so whether this 270 is our money and I could say, hey, we're gonna put, 50 in.
Okay, because you have a partner, that's why.
Right.
Okay.
And
Yeah, 'cause,
220, they're gonna bring 220. I mean, it's just I have to have 270 total to get
correct.
right.
Now, you also, just so you know, too, you can request tearbacks, which is what you have where they're holding the interest payments back. You can request on pretty much any type of
on any
loan from hard money.
I know, and I like to consider that only because it's one less thing you have to think about when you're flipping is making that payment.
It really does.
And it lowers the risk too. Like that's one thing that will lower the risk. You'll need a little more money out of your pocket at the beginning. But overall it's the same amount of money out.
Correct. And I think it's great to have when I was first started into doing the flips and stuff, there weren't these communities that were out there. So I had to calculate it out how you did yours as far as the golden rule minus rehab minus my holding cost, and that's what I would offer at.
Mm-hmm.
And then go ahead and finance everything because I know what I could get the money up for, and then I just do the tearbacks and hold it in there. But having in a community that you guys have is fantastic and allows opportunity to spread the wealth and also the experience. I mean, because that's where it is. It's in the momentum, the synergy that's created between people trying to get in and seasoned investors. I mean, it's always a learning game, and it's always growing. People are always growing in it.
Mm-hmm. One thing like on my terms when I estimate here, because not everybody told me how much I would need to show for liquidity. I just kind of just seeing a lot of these, I just kind of made an estimate. So these are like cash to close. Oh, that's what I wanted to point out. So cash to close, this is how much we would need to close, but then the total reserves that they would want us to show, which this one's not accurate probably, but because of the way it's calculated, but they'll want us to show like total reserves when we get started of almost 300,000, right? Which is very, very close to what the PML is, PMP that we're looking at, because, and a lot of that is because of, they want to make sure that you have reserves for the payments. But where this one stands out, is that because we're going to get the rehab up front, we don't have to bring the money to closing. And Jason could tell me how this works, but basically we're going to get funds at closing. So we're actually not bringing money to close. I'm assuming we're going to have to show like 250,000, but we won't have to bring it to close.
That's correct, because you're gonna be getting all your money for your rehab at closing. So they're gonna fund the full loan, and whatever you have that needs to be paid off will be paid off. I mean, so your purchase price is going there, and then your rehab costs are coming into your pocket minus your down payment.
Mm-hmm.
Jackie, put your hands on the bike like this.
So there's a lot of advantage there. And then, so when what's been a real eye opener for me starting this investing journey and fix and flipping is actually the liquidity side. Everybody's like, oh, I can get a loan. Well, if you're going to scale, you're going to have a chunk of money just sitting in the bank to show. And that's where some of these other type of loans, I think Jason kind of touched on it, but there's some other options out there where if it's not private money, because in my opinion, using private money can also be really risky because you're dealing with somebody else's, it's risky, but as much risky as just like scary because you're dealing with somebody else's money and having to and so many things can go wrong in a fix and flip. And so definitely like having that risk and having somebody else involved is tough. Whereas if you're taking it on yourself, you're taking it on yourself, I guess. So sometimes that's why I kind of touched on a personal loan, although they're done and I haven't sat and calculated them all out. The amount per month that you're paying is going to be quite a bit higher because it's not interest only. They're usually a term and they're usually 2 to 4 years, maybe 6 years, depending. And so if you get a $250,000 personal loan, that's a big payment. I haven't calculated it, but it's a big payment. So you have to take that into account. But it's usually a lower interest rate. It's usually maybe like 8%. And if you're paying off the principal as you go, obviously if you only have it for a year, you're not paying a whole lot of principal, but it's a much lower interest rate. So you have to take all of that into consideration. It's like, okay, do I want this on my credit for this year while I do this project and I don't have to deal with someone else's money, all of that, and so there's different programs out there and I have a couple of those that I can refer to as well. So.
Thank you.
Any other questions or?
I have a off the topic question.
Okay.
So this is about PML.
Okay.
I've had deals where, they wanted to pay principal and interest at the end.
That's how a lot of them try to borrow.
Yeah. So like they'll try to put in a JV agreement. Hey, like we're not gonna pay you like interest payment every month, but we're gonna pay everything at the end. Is that a good reason to see if the interest payment could be higher because we're getting paid at the end instead of getting
just watch for usury or decide if you want to take that risk, but just watch for usury. I mean, a lot of gators are getting 30% return in 6 months. And, how does that look? Because they're putting a lien on it, so it looks like a private money loan, but it's really more of a private money partnership. And so what's that structure and stuff? I haven't really seen very often that a borrower is going to claim usury against somebody, but it could happen.
Okay.
So it's
People
all
are
about
getting
trust.
30%? People are getting 30% in 6 months?
Yeah.
Wow.
Mhm.
That's like
It's super
literally,
high risk and a lot of people lose their money.
yeah,
So
yeah,
you
exactly.
have to know the people. So I only connect for like one or two other people that I know are doing well now. And my one of my borrowers, he does first position. He buys houses in Flint, Michigan, and they're like 30 that the loans are like 30 to 50,000 for the purchase and the rehab. And then he is a qualified refinance guy, so he can refinance them. He's already done
Yeah.
16. And so he's got 16 single families that he's already refinanced. He's already shown that he can do it. And in fact, I was his first book. I borrowed to him first before anybody else did.
Yeah.
And he was like a week late. A week late, and we got like 16% return in first position for 6 months. And
Yeah.
late fees. So that's first
Yeah.
position at 16%. I mean, that's a
Right.
32%. So
Yeah,
yeah, I caution everybody, usury. That's on you to decide what you want to risk.
the risk you want to take, right? Absolutely. Yeah.
And that's a lot with trust. And I mean, I trust this guy a lot, so he's not gonna.
And that's, yeah, and I think that's I started connecting with people, and I won't talk about money unless I have somebody like in a Zoom or
Thanks,
even,
Jason. Sorry.
yeah.
Thank you.
Yeah.
Go ahead, Simon. Sorry.
Yeah, so I'm just trying to find, like learn more so that I can, be a better PML and be better at underwriting and be a better connector because I'm learning how to do stuff.
I actually forgot to give everybody, as people are leaving, I forgot to give you guys my form, but I'll shoot it out here. Anything else? And it could be anything to do with the community. I'm an owners club, anything that you guys have questions with. Like I can point you in the right direction, or I can probably answer your question.
Do you mind if I schedule on your Calendly and then, set a time to ask questions and stuff like that at a later time?
Yeah, just reach out when you're at the point where you need some time.
Okay, thank you.
But if y'all wouldn't mind, the people that are left, if you wouldn't mind filling out that form, and then that way, if I do know that you're looking to be a buyer, because we're wholesaling, we're lending, I know we're all gators. We can almost all do EMD, but I can do EMD. I've got the resources to do really big EMDs. I got one coming that might be 10 million. I haven't done one like that before, but I have found the resources and connected with them. So obviously we all can do EMD, but if you need something a little bit outside the box, let me know and I can see if I can help with that. So, but just anything, otherwise I'll let everyone go. Edwin, Ed.
Hey, darling. How you been?
What do you got? What are you working on?
I just bought 2 houses up in Rhode Island this week. Just
Ooh.
closed on the one.
Are they co-living?
Um, no, actually, we're doing the burn method on those. Just closed on a multifamily up the road from me, so we're gonna turn that one. It's an 8 unit. 4 of them are 2 1s or 2 2s, and 4 of them are 2 2s, and The other four are 1-1s. We're going to turn those into co-living. And tomorrow I gotta go look at a fourplex.
Are you partnering with people? Do you have partners or
Yeah.
are you doing this on your own?
Come on, did I not learn anything from you? Come on now. Okay, the worst thing to do is not pick up from where I left off at. Of course. Um, I've got a few partners down here. Got Yen. Yen is up in Rhode Island, so I'm partnering with her. I got Bert down here. Ben, of course, Julie. Yeah, I've been pretty busy down here. Of course, I'm hosting our once a month real estate meetup down here. So been pretty
We're gonna be in
busy.
Miami. I'm gonna be in Miami in the spring, I think.
Woman, you better let me know when you get down here.
Well, you'll know because that's the OC retreat in like March or
Yeah,
February, maybe more like January or February, I guess.
it's in February.
February.
If I remember right, it's in February.
Mhm.
I thought it was in Colorado, wasn't it? What's in Colorado?
No, Squat Up. Y'all better be coming to Squat Up.
Spot up, yeah. Spot up is in Colorado. Okay. Yeah.
Uh,
Awesome. I cannot wait to get a hold of you, girl. I owe you so much hugs and so much thank yous. Guys, if you don't know our history, I'm just going to give you a really quick history. I'm not going to take much of her time, but she's the reason I'm as successful as I am today. So if you don't, if from here, when she hangs up from here, you're not following her on our chat that we have or on the Facebook post, you're doing it wrong. You need to follow her and Jordan. I mean, they've got a great deal of education and knowledge, and through them is where I'm at today. So you need to follow them. I'll leave it at that. What you do with what I just gave you is entirely up to you. I know I took it, and I know I can talk about it hard, hard. Extremely grateful.
we also
Yeah.
have a people that are just trying to start wholesaling. We have a group called Deal Forge. We don't run it anymore. Jordan and I were there, kind of sometimes, but we have somebody who's really good at keeping that running, and once in a while we pop in. But if anybody wants to be a part of the Deal Forge, just DM me, send me a text message, um, and I can put you in the group. But they'll help you look at properties, talk about making calls, all the different things in there.
And just so you all know, a lot of the calls that I make to these brokers, because today I've got 9 brokers in my pocket that I talk to almost every day. The conversations I have with these realtors, I learned it through Jennifer and through Jordan. I've learned it through them. I call them. We've gotten calls. Jordan has gotten calls. He's done live calls with them. And if Jennifer is saying what she's saying, you all need to get with Deal Forge, and I'm pretty sure they've got a lot of people on there that will probably get on a call with you and a realtor or a broker over a deal that you might think it's a potential deal. They will go over it with you. They will ask you for their financials and what you think the deal might be, why you think it's a good idea, so on and so forth, and then take it on to the next step from there.
And they meet 3 times a week. I mean, they cancel fairly often, but they meet 3 times a week, Monday, Wednesday, and Friday at like 6 p.m. Mountain, something like that. So it's a lot of
You need to hop,
availability there.
you need to hop on it. You need to get there if you want
And you
to.
don't have to be in, I think we're all in the community, but you don't even have to be in the community. I think we have some people in the free creative finance group. So
And I know at some point I gotta come back and say hi to everybody there. I
I
just
know
been
I gotta jump back on. I was actually on with Nick today. She's gonna start interning with us.
I'm gonna at some point I will go back there. Like I walked in like literally 10 minutes before you started the Zoom, and I was grateful that I did because there was an accident on the railroad track, so I had to go all the way like about 18 miles around just to come home. So I panicked a little bit, you know me. So, but I made it, and here we are. So at some point I'm going to get a deal for it and kind of hang out there for a while because that's where I started, guys. That's where I started,
Provide
and
value back to them.
yeah, I started there and I skyrocketed. And a lot of it, again, I can't tell you, I can't emphasize how grateful I am because a lot of it, days and nights, is with this girl right here. And she would educate me in ways I would have never seen it coming. Take it from a guy with 3 college degrees. I would have never made it as far as I am today if it wasn't for her or Jordan.
You always
So,
make me blush. Blama, can you talk to us? Can you say hi, or are you in a spot you can talk?
Llama.
Yeah. He's he's been working with me. We've known each other like 2 years. He's helping me helping people, bring people that need lending. But sounds like he looks like he's indisposed. I thought maybe he could say hi, but he's out doing outreach and bringing people to me that want to do lending so I can refer them to lenders. Oh, there he is.
Hello.
Hello.
Hey, hi to everyone. Are you getting me?
Big Llama.
How are you doing?
I'm okay, and you?
Good, good. Did you have
Yeah,
any
I'm
questions?
sorry for no, I was just following and then jotting down some notes. So for now, I don't have any question.
Okay.
Very good.
All right. Anything else? We're all just hanging out here, but anybody got any other questions?
How's JP doing?
He's doing good. Hunting season started, so I'll be a hunting widow now. But I don't even hardly leave my, it's like I go from my office to my bed, so they're getting kind of tired. I gotta start learning how to live life. It's coming. It's getting better.
Well, I used your advice quite a bit. I took a vacation about 2 weeks ago. I got this dog, so me and the dog took a vacation for about a week and just went into rented an RV and took off.
Nice.
So it was a good reset, well deserved and well needed.
Did you bring the did you bring the wife with you?
No, no, no. That was just talking because so she's the one that threw me out the house. She's like, "You need to go. You 18 hours." I'm like, oh, "Come on, man. Now 4:30 in the morning." Okay, whatever. She's like, "Just go for a drive." That drive turned into a week. She's like, "That's okay. Just stay out there. You'll be all right." I'm like, okay. Well, as long as she agrees, I'm all right with it. So yeah, that was a pretty good reset. Well, very well needed.
I love the story about your dog.
Yeah, spoiled dog. Spoiled dog. Got his own orthopedic bed. I bought him a car, so he has his own car now because he is not getting in my car at all. Got his own 2023 Kia uh Soul Tay or Celto or whatever, however it's
So
called.
what? So whenever he goes with you, you take that car?
I take that car.
Mhm.
That's the car we drive around wherever we go. If he's coming, that's the car we're going to take. Um, I mean, the dog is spoiled, Jen. He's just spoiled. So, but you can see in his face very grateful from when we first picked him up to where he is today. Very, very grateful. So,
So
yeah. And he gets me away from the computer like 5 days a week. Or I'm sorry, 5 times a day. He gets
five
me away
times
from
a
the computer.
day.
Yeah, that's what I meant. 5 times a day. So I catch that break anywhere between 20 to 40 minutes. Let's go for a walk. And you gotta go potty. So yeah.
All right. Well, y'all, if you have any questions or anything, or on my team, I could have said this earlier, but if you do need help underwriting, I do have a hireable team as well. So we can underwrite for you and help you with those kinds of things. We can help if you want to figure out how to look good for borrowers. We can help you with that. We're not doing a ton of connecting anymore, but we can show you the ropes and teach you how what people want to see and all of that. But all right. Well, thanks.
Thanks, Jen.
All right.
Always good to see you, dear.
Yeah, good to see y'all.
We'll catch up, okay?
Bye-bye.
I am.